Hello everyone, my name is Jonathan Wu, Chief Investment Specialist at Premium China Funds Management. Given ongoing global uncertainty affecting markets, I thought to keep you updated with a number of key issues. As you can see, Chinese equities, as well as some of our funds, have returned to positive territory year to date. For the first time in a long time in the face of crisis, Chinese equities have held up strongly, especially compared to their Western counterparts. The key reason for this is based on our belief that China was first into this crisis, and with extensive contact tracing, extensive testing regimes, as well as effective lockdowns, stopping widespread second wave infections, China has subsequently been the first out of this crisis and has led us to believe that China is actually going through a V-shaped recovery. Furthermore, that there have been a number of other key metrics that have allowed us to evaluate the current level of economic activity in China and therefore formed an asset allocation as well as stock picks for the portfolios. One of which is electricity production, which we use as a proxy for Chinese GDP growth, and this covers both the manufacturing and the services sector. For the month of May, it was up positive 4.3% compared to a year ago. And furthermore, new home sales, which is a key barometer of consumer sentiment in China, was up 9.3% for the month of May, and preliminary figures that have come in for the month of June show us that it's about 10% growth year on year. And the key important point to note here is that the figures are comparing against last year, not last month, where there was no virus and no crisis. Strength is also particularly evident in the fixed asset investment space due to a range of government stimulus measures, as well as strength in the housing market. Furthermore, when we look at forward-looking PMIs, the Composite PMI for the month of June came in at 54.2. Now, these composite PMIs make up both the services as well as manufacturing sector, and a figure above 50 represents expansionary activity within the economy. So given the COVID-19 situation, we believe there's going to be a divergence of growth patterns for countries going forward, in which there's going to be a larger gap between those that have versus those that have not. Especially when you take into account that some countries simply don't have the fiscal or monetary stimulus ammunition available like we see in places like China. If we then project our growth to around 2030, you'll note that China will become the world's largest economy, followed by the United States, then India, and then Japan will slip into fourth place. And if we look at the longer term drivers of the Chinese economy, being one, the continued rise of the middle class and therefore their income levels, as well as China moving up the manufacturing value chain, both of these remain intact and form key themes within our portfolios. As a value manager, we pay particular attention to the earnings outlooks when determining the intrinsic value of investments. And what you can see from both a earnings perspective as well as valuation, you can see that China and Hong Kong create very strong valuation metrics for you as investors to consider asset allocating into this area. And as the slide shows, if you compare this to places with high 2020 PE levels like Australia and United States, it becomes even far more compelling. Lastly, I'd like to share our view around US-China relations. No doubt there's been a lot of talk about global decoupling, effectively reversing globalization that has improved the efficiency of global supply chains over the last 100 years that's been affecting markets. We're of the view that over the long term, China and the US fundamentally need each other. There are four key areas which we believe this is true. We believe the US needs China for A, as a supplier of goods and services, B, as a supplier of credit, C, as a huge market for US products, and finally D, as a source of students, tourists, and talent. There may be some worsening of this relationship leading up to the US elections in November, but we believe that over the long term, cooler heads will prevail, and this forms our contrarian view. Another interesting point to note is that with all the talk of the US saying that they have a massive trade deficit with China, if you actually factor in US companies operating in China, manufacturing goods locally and services, and then on-selling them locally within China, the trade imbalance actually becomes very balanced. What I'm referring to here is things like Apple iPads, iPhones, Ford motor cars, as well as Starbucks coffee. Another interesting point is that there's also a convergence in the way that these two mega superpowers are running their economies, whereby the US is currently testing out state capitalism vis-a-vis QE, the buying of junk bonds, ETFs, as well as contemplating buying equities over the long term when crises hit, versus China that is moving to a more open and transparent economy when allowing more foreign participation in the areas of banking, finance, as well as insurance. So even if tensions continue to remain high between the United States and China, China remains to be an attractive place to invest given the valuation levels and earnings outlook. But if we're right, and the tensions do slowly ease over the long term, that will lead to a strong re-rating of PEs for Chinese equities, which will then produce stronger returns for investors allocated to this area. And finally, for Hong Kong and foreign investors, if you look at their combined allocation to Chinese equities at the moment, it is less than 4% of the entire market cap. So thank you very much for your time, and please reach out if you have any further inquiries.